Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon. We'll get rolling in just 1 second. Trying to figure out how to tweet this. Tweet. All right. It is June 21st. The Vixpiration is complete. It is the Weekly Notebook Review. This is Wednesday. It's 4:33 on the East Coast. Welcome all. Appreciate everyone tuning in, listening, as always. If you're new to the Weekly Notebook Review, what we do here is kind of run through the gamut in terms of the global macro setup, and especially things that have kind of changed or shifted from our weekend work to midweek. It's a little bit of a short week here in the U.S. as Monday was a holiday for Juneteenth. But again, we're kind of going to talk through this for Hedgeye Nation to talk through various setups, kind of trying to get their portfolio in a good place for not only tomorrow, but next week, next month, next quarter. This Q2 quarter is almost complete. We got about 10 days left, I think officially 9 days left in the quarter to really try to, and then we'll have kind of the first half complete, right? So as Keith has been saying the last few weeks, it's certainly not about the year-to-date number, but I know many do focus on that. We prefer to think of through things on a cycle-to-date metric, and the cycle started for most of this, not most, but for much of the assets out there. Certainly U.S. equities was kind of November, December of 2021, depending on which equity you're looking at. But regardless, the big thing today is obviously Vixpiration, right? So and that really has trickled through just a lower volatility regime really across the board. If you look at VIX, RVX, VIXN, the move kind of traded pretty much flat today. OVX was down a little bit, almost 4%, down back to 33.26. GVZ's trading, it was up a little bit, but down in the closed at 12.98, so sub 13. So again, volatility just in general is really kind of suppressed, but not, I won't really say manipulated per se. It's just a lot lower, and I think you just got to kind of change the way you think about things. The way that I'm doing it or thinking through that is by increasing my position sizing a little bit more, so have the flexibility of going a little bit bigger with volatility a little bit lower across multiple asset classes. But again, you got to kind of just work through it however you see fit. If you give me 1 second, my son just popped into the office. Give me 30 seconds.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
I apologize for that dead air. He had a very important question, which was, where's my iPad? Because he needs to look up an old Lego, what is it? I guess design or instructions so he can build one of his Ninjago things. So very critical stuff here, guys. Apologies for that, but appreciate you bearing with me here. So again, Vixpiration, that's probably going to be talked about everywhere. I think to me, one of the more interesting setups was certainly the real-time alert from Keith earlier today on D-Dog. This is really his first time going long anything technology for quite some time. And in that commentary, he made a comment about kind of how folks didn't want to be buying, Qs on red today, and yet they've been kind of wanting to try to buy them all year. So again, it's I think just working through what's being presented to us on the board, Nasdaq is now bullish trend, and we can comfortably, according to the signal, kind of get long some of that stuff. So again, I dipped my toe yesterday. I tweeted that out in terms of getting long a little bit of QQQ. Did so again today. So again, building up a mid-sized position there on the Qs, but really it's less about kind of what I'm doing and more about kind of the other kind of makeup and some signals that are weakening and strengthening, and certainly the USO, aka crude oil, was something that was, and Bitcoin really. Bitcoin had quite the move. So is this another kind of month end markup, quarter end markup? I'm not sure. Crude oil was kind of pushing up towards the top end of the risk range, sort of the top third of the risk range, I'll say. Again, this is it's consistently made lower highs ever since last summer. So it's been almost going on 11 months now. But at the same time, we did see some volume today, and really one of the, I'd say, an important piece of this puzzle is kind of putting things in the portfolio or tacking away from things in the portfolio that might be or that might be either picking up signal strength or losing signal strength, either from the long side or the short side. So USO is certainly one that we remained short of, or oil, I should say, crude oil is what we remained short of. But if I had that position on the short side, I'd be kind of certainly it would be on my radar. Now, I wouldn't necessarily be adding to it here in kind of the top third of the range, and be looking for it to kind of confirm and certainly try to put in another lower high. The most recent sort of 1 month high, just so that everybody's got it, is up at 74.34. So again, almost a full $2 ahead of where it closed today. But it's just little things like that you got to be kind of paying attention to. And if you think about where the flip side of that though is it did just literally last week on Monday the 12th, it put in a fresh 3-month low and 1 month low from a closing price standpoint. That was down at 67.12. So, this is very much just almost kind of one of those things going from the bottom end of the range to the top end of the range. But it will be just interesting. Again, just something to call out here. Just kind of be interesting. Keep on an eye on in terms of how does it sort of act the next few days here. I'd say kind of going into the end of the week and into early next in terms of does it kind of pick up price action to the upside on volume with volatility kind of continue. OVX is how you track that, with OVX continuing to sort of move a little bit lower. But again, these metrics. I mean, OVX isn't quite at a 1 month and 3 month low, but it's pretty darn close. That low also, interestingly enough, came on the following day on Tuesday, June 13th, down at 32.38, and as I said, it closed at 33.26. So, just one thing that I really certainly I went to go maybe add to the oil short today and kind of just let it breathe a little bit. So gold on the other hand was just sitting right there yesterday. You got an even better spot this morning to pick some more gold up. That that GBZ, that gold volatility, is kind of doing exactly what you'd like to do it. So again, today with a little bit of up move and volatility, but you're sitting, at almost 5-year lows. I think. Let me pull that back up. I believe. I mean, you're sitting at pre-COVID February 2020, basically lows for GBZ right now. So this is again. Gold volatility is doing exactly what you want to see. Coaches have talked about this a couple times on the macro show, and it's been great questions from folks out there on the macro show in terms of the U.S. dollar and gold correlation that continues to kind of break down. So again, that setup is probably one of the best on the boards at the moment. The other component too, if you noticed, Keith put the Z's on. So the Thunder Bay Bear is snoozing on SPY short at the moment. That happened at a very nice time this morning, and he was doing a lot of covering in terms of the short book, right? So he had South Korea today, and that's something that I want to get into in terms of the kind of Asian complex and what that's looking like. But I think Coach Keith really worked well in terms of risk managing kind of the short positions. One of the interesting ones from an RTA standpoint this morning was his cover on Europe. On the FXE. So the euro is the word I'm looking for, not Europe, euro. And that was nice. The reason why I bring that up is because he commented how the signal had shifted, and it was just telling him to kind of cover FXE. So again, these little components, he's not shy of basically making that move and making that decision and that shift. And again, these are things that you want to be calling out, because the euro certainly in the last kind of 2 weeks or so, week to date, it had a good number. It remains sort of, I believe it's neutral. Yeah, it remains bearish on the trend basis, but certainly is picking up in terms of price action and momentum to the upside. Awesome. Sorry. It is a hectic afternoon here in the McGrory household, and the kiddos, although normally very good at respecting the office and the closed door, I think they're just excited to be on summer break. It's officially the first week of no school here in Amesbury, and I think it's just got the brain a little bit. There's just beautiful sunny day, but let's keep on rolling. So the euro, that's picking up strength a little bit. Remains bearish trend though. The pound is bullish trend and has been so for a few weeks. So these are kind of some interesting components here. We remain short of the Japanese yen and long of Japan and the Nikkei itself. So this is where I wanted to get into from an Asia standpoint. Coach did hit the button on South Korea. India has been added to ETF Pro recently. The Asian complex, certainly there are some equity markets there that are looking very attractive, and we have gotten long of the Nikkei for a few weeks now. I believe it was mid-April was when we when we first initiated that position. And now both India and South Korea are creeping onto the board. On the flip side of that, we've got short on the Australia front, and that continues to look pretty good. So again, whether Australia if it has anything to do with its sort of reliance and kind of interconnection with China and the Chinese economy weakening, who knows? But regardless, the signal says to be long of South Korea, Japan, and India, and short Australia. So that's kind of what the Asian market looks like at this point in time. I think Bitcoin, just since that's kind of right below the component here, Bitcoin, again, an interesting couple days, really, I guess, last 10 days, put in a fresh low on a 1 month and 3 month basis, similar to what you saw in oil on that, what was that? That was on a couple days later on Wednesday, June 14th, but has absolutely ripped higher and has put in a fresh 1 month and 3 month high as of the close price today. Now again, you go back this is a good component in terms of cycle time and cycle to date. We're sitting at $30,000 here, 37. That cycle peak was up in around 63 and change, 64 and change, I believe it was actually. 65,510 was the actual cycle to date high on November 8th, which again is very same date coincidentally on the NASDAQ in terms of its cycle high as well. So again, this is a huge lower high here on a cycle standpoint, and this is something that Keith has really been getting after it and really trying to reiterate that for all of us. So I think the cycle to date is really important. As my colleague Jamie Bruno likes to say, it is about where you come into the movie in terms of how well you like the movie. And if you've come into the movie in any time in the last 6 months, probably haven't liked the movie a whole lot. But if you came in when we made the pivot back at the end of 21, it was a hell of a 2022. So right now, what we got to figure out and talk about and work through is continuing to stick with our process and, having a hell of a H2 2023. So this is, there's been a lot of great things to be long of this year that we have been long of. One thing that I think is really picking up a lot of signal strength and something that Keith has been referring to and is mentioning. And what I will say to those that are listening in is when you kind of notice Keith talking about something in a couple different formats, whether it be the early look or RTAs or the macro show, et cetera, definitely be paying attention. He's mentioned BNDD a few different ways this week alone, and that's how he's expressing the longer end of the curve exposure and basically the recession risk that continues to rise. And you're seeing that from, I mean, today was a hell of an opportunity to pick up, basically to express that exposure on the long side. You had both the 10-year and 30-year were in the morning were up pretty significantly, almost to what they were. I think the high was 3.822. Yeah, I mean the 10-year was 3.85, so almost right to the top end of the risk range, and yet it peeled off, the rest of the day and closed down at 3.725. So that's what a 10 basis point move from basically the high of the day to closing price. So again, great opportunity to add the exposure like BNDD. You could also go again to express the kind of the longer end of the curve, the 30-year, which is officially in bearish trend mode, would be things like even EDV or zeros, TLTs. Certainly, how many express that exposure, but Keith is definitely very keen and has been saying and has been expressing that the way that he's doing it is through BNDD, and you can see that across multiple components of the portfolio and asset, and kind of whether it be through the re-rank product, or I believe it's an ETF Pro as well, but I could be mistaken there. Anyway, all right, so let's open the floor up to those listening in. There's a lot of great friendly faces, wonderful commentary as usual. I see my boy Chris Moyer from the UK. It's getting late there. Wasim from Toronto. We got quite the international base here. But again, yeah, everybody wants to kind of pop up, share their how they've been kind of risk managing their portfolio and book. Happy to do that. Or we can kind of I can certainly keep chatting along, but this is really for Hedgeye Nation, and I've always found that it's better when it's sort of a multi-conversation component here, or back and forth, all that kind of stuff. All right. Everybody hop up at once. Nat gas. Sorry, while we're kind of talking through some of the commodities and stuff like that, nat gas had been neutral yesterday, but moved back to bearish today. So some of this commodity complex I think is quite interesting, and if you're not paying attention to it, you certainly should be. Some of the things that certainly popped out on the weekend was the recent strength in corn, soybeans. Pretty much most of the agricultural complex, and most recently, as well as nat gas, and that's really kind of uranium also stood out to me actually over the weekend as well. But nat gas in particular, was flirting with neutral. Flirted with neutral yesterday. It'll be interesting to see if it maintains its bearish component. I think it will, because that trend level was 2.61, closed at 2.592. So right kind of flirting around that trend line as of yesterday from Keith on his signal. But that's certainly something that I think is really interesting, right? Just sort of like how nat gas is not even really trading all of that in line with crude as of late. And again, not that they do, but I do believe that they have a kind of historical correlation sort of with each other. But my boy Timbo is out there, so I don't know if he's got any update from the field. But again, he was on Tim was on a couple weeks ago, probably a couple months ago now, talking about oil services and OIH in particular, and that was great timing. So again, we remain short of energy exposure in general. So the way we're expressing that is through XOP at this point in time. But again, OIH has been certainly a great one on the short side in the last, really since March. And yeah, but nat gas is looking kind of interesting here on the long side. So keep an eye out on that one. That was certainly something that I've had circled over the weekend. From a kind of commodities-ish precious metals component, the things that I had on my board were gold, soybeans, and nat gas. So just keep that in mind as we move forward here. All right, well, no one wants to jump up. Let's talk about the Canadian dollar. We'll go back to FX here. No, we're kind of bouncing around, so apologies for that. Canadian dollar is neutral on the board. So Wasim, there's a chance. There's a chance the Canadian dollar could go back to bullish. We'll have to see because it's come a long way from what was its cycle peak? Its cycle peak was back in late May. Maybe not actually, mid-May. So that cycle peak was spot 8284. We're trading down at spot 7596. That does kind of correspond with the the early half of 2022 when energy and oil certainly continued to have a good run and maintain their bullish trend. So let's keep an eye on the Canadian dollar. This is potentially a head fake here, and typically in a neutral trend is what we would call a wait and watch situation. So I'm currently not doing anything with the Canadian dollar, but again, these all kind of are correlated with each other, and one, whether it be energy, nat gas, commodity complex as a whole, aka natural resources, the Canadian economy, what is the Bank of Canada doing, et cetera, et cetera. It is all kind of tied. And I know my good friend Chris Moyer, who I've already mentioned once tonight, he has explained on here before how the U.S. dollar's kind of weakness in the last few months could be kind of related to the fact that the rate of change of the Fed in terms of their rate hikes or potential rate hikes is lower than other countries like the Bank of Canada or perhaps the BOE that's on Friday, et cetera, et cetera. So these FX components do play off of where what the central banks are doing with their rates. So I got a question. Somebody came in. Let me see here. So it's, what's your opinion on the metals, gold, silver, copper, uranium? So I kind of just answered that, but maybe he's bouncing in. So gold and silver, both bullish trend. The setup there, I think, both gold and silver are sitting right there for the taking. Copper is one that this would be an opportunity, in my opinion. Keith hasn't gone to the wood yet in terms of. Oh yeah, sorry, he is short copper in RTA. So this is definitely one where I would be. It's to where the HG close 3.90. So top of the risk range is 3.95. We were up there today on, that's why I was kind of confused where it closed, because we at the high today I think was 3.926. So we were up there on copper. So I would have been. I didn't put that one on the board. I'm trying to kind of keep a little bit more of a concentrated book just for full transparency. The days get pretty busy here at Hedgeye, so I'm kind of trying to keep it to sort of basically 8 to 10 things that I'm trading currently. But copper, definitely, if that's something that you are trading, or from a base metal standpoint, or metals in general, it'd be copper on the short side, silver and gold on the long side. Uranium is certainly interesting. I was looking at that from URA standpoint. So that's the uranium equities, so the companies. I haven't actually looked at the uranium futures in a minute, but URA certainly has had a big move in the last month. I mean, basically going from low 19, what was it, 19, close down at 19, spot 28, and today's up at 22 spot 31. So it's had a huge move in the last 10 to 15 days. I don't know if this has anything to do with CTAs or anything like that, but that also is primarily Chemico, I believe, is the largest holding inside of URA. But that certainly looks very, very good. And I don't have the signal from Keith because I don't have that, but that would be certainly one that I would be looking to perhaps add on any kind of weakness here. But again, this is all it's kind of, as I mentioned, sort of correlated to the energy complex as a whole. So if there is some additional weakness there, then you could see URA certainly come back, and this could just be a bit of a head fake to a lower high, because that cycle high in URA again dates all the way back to November 8th, actually, the week of November 8th to 30.14 is that kind of closing high on a weekly basis. So again, this just kind of keep track of those cycle to dates. But good question. Thanks for that. Let me see if anything else out there. Pretty sure it wasn't a top tick. Not sure. So yeah. All right, guys. Well, no one wants to jump up. And we can just keep this to a quick 30 minutes. I think this is a good run through. Tim says he's in the car with loud kids on vacay. No worries, buddy. I hope you're having a great time. I know this is the summertime. It is the holiday season. Well, not really the holiday season, but the holidays in terms of vacations, summer vacations. Here we go. X2's jumping up.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
X2, how you doing, my man? You're on mute, just so you know.
Hey, Robert, how are you?
Yeah, doing really well, bud. How are you?
Also in the car. So, but last time I jumped up, that opened the floodgates. I figured maybe it's just the
Yeah. Hey, listen, X2, I appreciate it. Right?
Whatever works, right?
Yeah, whatever works. And again, if we just want to wrap it up in 30 minutes, it's fine with me. As you can tell, I've already been interrupted like 3 times from my own children. So Well, what's on your mind? I know you love to trade the euro.
I love to trade the euro. Yeah. So the euro is still bearish trend. You said, right?
Yep, bearish trend. But I believe in the early, like yesterday, he actually didn't mention it. He often mentions he didn't mention the euro though yesterday. So he often writes down whether it's the trade as well. So he mentioned the pound was bullish trade and trend. But the euro, I would have to think. Again, I don't have his signal right, but if you were asking me to kind of take a pretty good guess, I would have to think that has gone back to bullish trade, but bearish trend.
Yeah, I mean,
just where it put in again, it's not perfect, and his duration probably goes longer, but on a 1 month basis, it's a new high today at 109. 1.09861. So
yeah, it went through the top end of the risk range, even his risk range today.
Yeah, exactly. Yeah. But again, those risk ranges, that's a good point. I mean, those, as we've talked about this at length on here and many other places, those are dynamic ranges, right? So as the price moves higher and both volume and volatility start to play a role, those will change. But it's the closing prices that matter the most, and that's what influences the risk ranges in the morning. And so, that is the immediate term range. So coming into today, I think when something goes to the top end or through quote unquote through the top end of the range or the bottom end of the range, from what was printed in the morning, one of the biggest things that we should be thinking about there is that this is an outsized move, right? So coming into the day, the price volume volatility components that were being measured and mapped by Keith, this was basically an outsized move because those immediate term risk ranges incorporate basically what is kind of the probability of what could happen today. So when you get that set up, whether it be in a bearish trend or bullish trend, and again, if it's bullish to the bottom end of the risk range, that then becomes almost an even better opportunity to execute. Now, I say that because it's not, I've been tagged in a number of tweets over the last few months where, folks have been, shorting QQQs at the top of the risk range, through the top end of the risk range, and obviously that was not working very well. So this is where I really go back and I highly recommend the deliberate kind of execution in terms of writing down if things are making higher highs or higher lows. So if they're making higher highs or higher lows inside of higher low inside of a bullish trend, then that is a very good thing. So if that's been what has been transpiring over, say, last few days or weeks in a bullish trend, and then you get an outsized move to the downside below the bottom end of the risk range, then that's a great place to execute. Now, if that was happening in something that was making lower highs and lower lows, and then you get a move below the bottom end of the risk range, that's something where I would, the system would have you execute, but you'd be doing it in a much smaller fashion because that risk range is basically is losing signal strength, if that makes sense. Did I explain that okay, X2?
Yeah, that makes sense.
Yeah. So for instance, I mean, if we just go back to the 15th of June on Euro, the top end of the risk range is 1.085. Today was 1.096. So that's a higher high, and the low end of the risk range today is 1.064, and on the 15th of June is 1.065. So that low end of the risk range is actually basically called flat or slightly lower. But that top end of the risk range is a whole penny higher. So that to me is something where on this move to the upside, if I was building a position, it could be a decent place to like kind of start a starter position. But if I already had the position on, I'd be kind of having it at your minimum size or mid size, waiting to see, does the signal shift, does it change, and on that trend break, if it comes, then you would be completely out. But you really kind of want it to kind of almost like confirm here, even though it's to the top end of the risk range. It's been making higher highs, and again, that's a new 1 month high, but that 3 month high is all the way back up, close to, I think, like 110, wasn't it? Yeah, one spot 10594. Yeah, so call it 110 and a half. So again, like until that, if that top end of the risk range though does start to put in 1.105 or 1.11, then all of a sudden you're like, oh shit, the euro could be putting in not only just confirmed 1 month high, but it could put in 3 month highs as well, and back up to basically breaking out to recent highs on the from the signal standpoint. And again, given his component in terms of what he mentioned in RTA in terms of like the signal sort of kind of is telling him to cover FXE, then that's sort of another inclination that perhaps it broke to bullish trade, but remains bearish trend.
I appreciate it. You don't have the trend level on the euro, do you?
I don't. We haven't gotten that. No, okay. Not in a while. No. Good question though. I wish.
All right, I appreciate it. Thanks.
Yeah, man. Thanks. Look, you've already inspired Tom to jump up XT, so you've done your job, buddy. You've done your job, buddy. I hope. How you doing, Tom?
Hey, Robert.
Great. By the way, great work this week, man. Great tweets. Really interesting your study on the risk ranges. So really timely that since I just kind of went into a little bit of a risk range, I guess monologue there or dialogue with X2. Timely that you stepped up, but really appreciate you sending me over that Excel sheet, man. I appreciate that.
Oh, you're quite welcome, and thank you, Robert, for everything you do with the extracurricular activities beyond Hedgeye, like this weekly review and so forth. This is great. So yeah, I thought
Absolutely.
since we are on the topic, I thought I'd share a little bit of what I've learned doing that little exercise, and I'm still studying it. And I'd really, if Robert, you have a chance to look at it and develop any insights or information you'd like to share, I'd certainly like to hear what you learn as well, or maybe you already have those insights to share. But I
dove into it yesterday afternoon yesterday evening when you sent it over. So I've only kind of had it on me for a day, but I definitely want to get on the phone actually with whenever your time permits, because I'd like to kind of just slightly better understand the calculations and stuff in terms of what you've done, and for those listening in, because you don't necessarily know what Tom sent me or what Tom had tweeted the other day, but basically he's done an analysis on our daily risk ranges, and he's gone across all of the asset classes or assets, that the pieces of inventory that we publish daily. I believe if memory serves, Tom, it was across the last 2 years, right? Going back to 2020.
Yeah, I started my subscription to risk ranges in August of 2020, and I've got that whole list of emails that were sent out since then. So I basically gathered all that, put it into an Excel spreadsheet, and then used pivot tables to analyze it. So it's everything going back to August, probably about the beginning, I think, of August 2020 up to current. And
Cool.
it was
Cool.
kind of interesting. One of the things, as far as, if you're doing the, buy near the low risk range and sell near the high risk range, I modeled that. I mean, I've only got a few data points, basically the previous close, the high and the low risk ranges, and, the bull bear neutral
Yep.
trend. So
Yep.
you have to, so unless you try to aggregate a bunch of other information in, which would be difficult, very time consuming and difficult. So I basically went with that information that comes straight out of the email. So what I found, and this is where I'd like some help, maybe kind of thinking it through. But what I found when I modeled it such that if you get within a certain level of on the opening, which is yesterday's close. So on the opening, looking at the current risk ranges, if the yesterday's closing price is within a certain level of either low end or the high end, you adjust your position size. So I took I call my lowest position size a 1, my mid position size a 2, and my high position size a 3. So if you're net down near the low end of the risk range, you take on a 3, and let's say you use 5,000 as your 1, 2, 3. So it'd be 5, 10, 15,000, just as a calculation point. So if you're down near the low end, you take on a 15,000 position. If it's in between the those limits, you take on a 2, and if it's up near the high, you take on a 1. But as long as the trend is bullish, you always keep on at least a 1. You never go less than that 1. So you'd always have a $5,000 position on it. Are you with me so far?
Yep. Nope. Yep.
Okay.
Makes perfect sense.
Yeah. So, and then I changed that. I call it the proximity value. So I tried everything from a no proximity, which means it's got to be at or above those levels in order to trigger a bigger or smaller position, or it just always keeps on the large position. And what I found, modeling it that way, I actually found that as long as it's bullish trend and you put on the full position, it works the best. If you start scaling it back, so let's say you're within 10% of the the proximity is within 10% of the higher the low value, or within 25% of the higher the low value, whatever. You get the smaller you make that proximity value, the smaller your overall gains across all the assets that were under consideration during that time frame becomes. Now, of course, it changes depending on each of the symbols. Now, I haven't gone through and analyzed that carefully yet, but I thought that was amazing. That okay, if it says bull, just put on your position and don't worry about finagling it, up and down. Just stick it on there until the signal turns neutral or bearish, and then adjust accordingly.
Yeah. So the way that you tackle that, I thought it was interesting because it kind of goes more towards the trend following component, right? So a bit more like a CTA across basically all the risk ranges,
Exactly.
which
Yep.
which I thought was yeah. So that's certainly um, uh, yeah. I mean, I think that makes a lot of sense. It's certainly how Chris, who he basically is listens to a ton of. He's introduced me to a lot of different CTA podcasts, stuff like that. So I've definitely gotten more into that mindset, and Keith is we've always I think kind of talked about it on here how he's at heart really a momentum trend follower, right? Momentum trend
Yep.
trader,
Yep.
but
Yep.
he just trades it really tightly, right?
Right. Yeah.
And the other component that I thought was quite interesting, I just pulled up your Excel sheet here, Tom, was the best part to me was that the U.S. Treasury 2-year
Yeah.
had the best returns. So like the thing that basically has the least amount or relatively least amount of volatility had the best total returns. Going deploying it in the format that you just listed, which I thought was quite interesting.
Yeah.
It was
Well, if
followed by, and then the best part was, Tom, is that it's followed by the Bitcoin, right? So it's like you have
right.
like kind of one of the least volatile things, and then one of the most volatile components, both putting in like what coming in as 1 and 2 in terms of total returns the last 3 years.
Yeah. Well, if you think about it, though, that what we talk about interest rates first. So interest rates
Yeah.
have gone from practically zero to much greater than
Yeah.
zero
Oh
during
yeah.
that
Oh yeah.
time, and you see that bump. If you break it down by quarters, you can see where that bump occurs. And the same with Bitcoin.
100%.
It had a big it had a big swing during that time too, both up and
Yeah.
down. And I think the bull bear signal would have caught that. I haven't looked at that too carefully, but what I have noticed is that the bull and the bear signal, when it switches, you go. In fact, one of the things I also noticed, I haven't modeled this yet, but when it goes from, let's say, bearish to neutral, the way I modeled neutral is just no position. If it's neutral, I didn't do anything. But I think when you see it go from bear to neutral, you just take a long position, because that looks just, scanning through each of the charts, that looks like a good time to go. And conversely, I think when it goes from bull to neutral, I think that's a good time to put on insurance.
Yeah, I mean, navigating neutral is tricky. I mean, that's kind of why we deem it sort of a wait and watch mode,
Yep.
because sometimes it can be head fakes, right? And then it like basically resumes the same, like the previous signal. So I would actually say, Tom, I'd actually kind of have the other side of that in terms of kind of risk managing it. It's
Sure.
almost you want to kind of keep on the prior signal. Again, I don't have the math behind it, but I'd be curious. We should actually run through this and review kind of what is the conditional probability of basically neutrals flipping, aka transitioning to a completely new signal, or maintaining its prior signal. So I think that would be something of interest. I think just anecdotally, because I joined actually pretty similar to you in terms of, I was more Q1 of 2020, but anecdotally, I think those neutrals can often be often do flip back, right, or at least take some time.
Oh.
I think anytime that you're kind of around some, call it quote unquote decision points, right? Whether it be like the euro, for instance, is a really good example that we just talked about in terms of likely going to bullish trade, but bearish trend. And it'll be interesting to see if or when that signal might go to neutral, because again, this is like one of these things where what. It also kind of depends on where are you coming from, right? As I mentioned earlier a couple of minutes ago, in terms of the euro, if you're just starting a position in the euro, then today could be actually kind of an interesting thing to do. Even though Keith covered, basically, hit the buy signal in terms of a short cover on FXE and RTA and made that commentary, right? And but if you already have the position on, then really kind of waiting for riding it out on the minimum sizing. That is exactly what you were referring to in terms of kind of staying true to that trend following component.
Yep. Yeah, there's always, I've done a lot of studies with trend and mean reversion and so forth. And
cool.
those transitions are tough, and you need to have, in your strategy, you need to have some type of hysteresis in there so that you're not constantly flipping back and forth, especially if you're paying fees, like if you're doing, if you're trading options or futures or something that have fees. The fees will kill you trying to toggle. The beauty about, I use TD Ameritrade, no commissions whatsoever on ETFs and stocks, even shorts and all that. There's no cost associated with that. As long as you keep your bid-ask spreads, you don't want to pay that gap between the bid-ask spread.
Yeah.
But the beauty of using that on a highly liquid thing is if it's toggling and you toggle back and forth 3 or 4 times, sometimes I'll do that in a day. You don't care because it's not costing you anything. You're managing your risk by not taking a big loss. But if it runs in your favor, you're gonna get that gain.
Yep. Yeah. I mean, there's a lot of different ways. You could even do, again, I see there's a lot of, I'm sure, better options people out here, and I've been very upfront that my options game is very rudimentary at best. But you could also do kind of like a spread, right? A longer dated spread, or even whatever. It doesn't matter. But basically, there's different option strategies too that you could also kind of express that, and therefore you kind of you can buy a call or put right on either level of, or top end of the risk range or bottom end of the risk range. Especially like Nat Gas, I think was an interesting one to kind of maybe do that yesterday, where it was sitting right on trend, but you you were kind of and near the top end of the risk range. Well, sorry, the bottom end of the risk range was so much lower than where it's trading down at 2.16 yesterday, right? So if you could have, anyway. That gas to me is a fun one to trade, but you got to trade it in got to trade it in small increments, otherwise you blow up your account.
Almost every time I've tried to do anything with natural gas, and it's usually with the boil and what's the opposite of the boil? Cold. I think it's cold, KOLD. And I just get spanked, so I just try to leave that. Sometimes I can't avoid temptation, but usually I get
I like
spanked.
it. Well, as I said,
I'm better
I mean,
off leaving those alone.
in the last sort of like 3 weeks, I've gone down to kind of trading just like 10 things, and I'll tell you, my performance has improved. Let's just put it that way, I guess.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40 plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
You start learning to avoid the pain. Is that it?
Well, I was getting too spread out and then the work's just quite busy, all that kind of stuff, right? So
well, yeah.
It's and just travel and work and family and all that kind of thing. So it was just easier to just narrow down the focus, right? Just narrow down the focus. Yeah. Well, I see Chris jumped up when we were kind of talking about trend. I don't know if he had anything he's definitely, I won't say introduced me, but certainly has introduced me to a lot of different great CTA and trend podcasts. What is that? It's Top Traders Unplugged, right, Chris? They've been doing they've been doing a trend following kind of series this year, haven't they? Or certainly so far this year.
No, they are a trend. Well, they are a group of trend followers, but they've gone the other way and they're going like full on macro craziness. So maybe 1 out of the 4 a week might be interesting. The rest is just macro shenanigans.
So is that why you only send them? I thought you just didn't really like sharing with me, but I guess it's just you've only been sharing one every 4 weeks because that's just the ones that are good.
Yeah. No, so like I've not seen the work that Tom's done, but in 2021, I think, I didn't have a spreadsheet of all the risk ranges, but I kind of put out a request to Hedgeye Nation if anybody had them in a spreadsheet, and lots of people stepped up and gave me, so I was able to cobble together quite a few.
Oh, cool!
I focused on the S&P though, just because I had an itch I wanted to scratch. Because at that point I was going through lots of gamma stuff and options, and so on the S&P, the thing that I came away with was that if you look at any of my old videos, I always use a center line on the risk ranges, and basically.
And that's, sorry, Chris, that center line is truly just like the midpoint?
Yeah, okay. So literally, if the top of the range is at 100 and the bottom range is at 90, then the center is 95.
Okay, I just wanted to make sure I understood. Yeah, thanks.
Yeah, and then so kind of in line with, well, I don't know if I'm kind of forcing this into it because, like I said at the time, that's what I was kind of learning about. But kind of in line with gamma, that when gamma's positive, prices are more likely to go up. And when gamma's negative, prices are more likely to go down. That's kind of the center line is quite, at least for the data that I had, does become a differentiator that when the prices in the top half of the risk range, the daily moves are more likely to be lower, but they're more likely to be positive. I can't remember from the I think I had 600 data points. So that's nearly 3 years. So going from 2019 through to the end of 2021, for the S&P. So like there was obviously there was lots of stuff going on there. Conscious of a lot of the move from November through to the end of 2021, but so when it was in the top half of the range, it was more likely to be positive, but the daily moves were lower, and when it was in the bottom half, the moves were larger, not by a lot, but tended to trend lower. That's it.
Interesting.
But yeah,
Interesting.
But the other big component is Keith's been talking about it a lot, and some of the he talks about it a lot, and the charts have made it into things like the macro show and the macro quarterly updates. David Salem brought it up on his macro show a couple of Mondays ago. I've shared a really crappy chart. The big differentiator, like obviously that's at the trade level, but the big differentiator for returns at the quad level is quad 3 and quad 4. So basically when growth is slowing, you have the massive dispersion in outcomes. So when we're in quad 1 and quad 2, the moves over a given time period, the chart that I produced was at 20 days. So the 20-day forward return was lower, but was far more likely to be positive. Whereas in quad 3 and quad 4, that's when you have the forward 20-day returns can be plus 25, but they can also be minus 35. So that's taking it from the trade level that Tom was just talking about down to like the quad level. That a big component of this is however we move through time going now, is that yes, on a trade basis, things like Qs and everything were longs, but we were still, and we are still, in this wide dispersion, and it's not uncommon to have 30% moves, because that's what the data says. But just as likely, when growth is slowing, for you to have a plus 30% move in a 20-day period, so like plus 10, plus 15, whatever, in a 20-day period, is you're just as likely to have a minus 20. So yeah,
that's awesome. No, appreciate it. I'll have to get that that risk range data from you, and we can try to combine that with what Tom's done here as well, and then we can kind of share it with the nation. So thanks. Is it Eladio?
Yes, hello. How are you doing?
Hey, good. How are you?
Good.
Welcome.
I have a lot of respect for people that look at all the data, the quantitative analysts, I call them the gabba-dabba-doos, smarter than me for sure. I'm more of a trader and a money manager, but the bottom line is we're in a bull market, and this market bottomed on December 28th, and we're going to see a rotation. Unfortunately, the bottom was in a funnel that went to 20 stocks, and then 20 stocks that have priced in an absolute perfection. They priced in the China opening. Well, so much for that, because they're slowing down pretty fast. Last I heard, semiconductors are pretty leveraged to China, in spite of all, our trade wars. And the bottom line is we got into the absurd in the last 3 days. Last Friday was the day to start shorting this market on the semiconductors. But the beauty is you got to be very selective. I think that you can't do the same thing with the QQQs because of the bifurcation that exists. If you look at Google and Amazon, they've lagged. If you look at Netflix and Meta, they're probably no different than Nvidia at this point in an incredibly overbought situation. The AI thing was introduced perfectly at a time where we were going through a banking crisis, and that added fuel to the fire. But I think the bifurcation still exists, and Tesla's still probably going to be a buy. And we have an opportunity here where we're going to see the money that went into the 20 expand to the 100. It won't be as fast. The rotation is going to be very painful. It's going to last about 3 months. That doesn't mean that Tesla can't hit all-time highs, and that you can see Netflix and Meta down 20. The bifurcation, the markets are still broken. And this is a very exciting time. It reminds me a lot of 2009, but with it's a slow recovery, and I think we're going to probably overdo it. And then sometime in the fall is when we're going to experience some type of maybe setback. But right now, Thomas Lee's been right, and now we need to see an expansion into the value areas, into the industrials, into the financials, into the regional banks, into healthcare, which have absolutely been decimated. You started to see the beginning of it, but it's going to take some time, and it's going to be messy because it's from 20 to 100. And some people will be dumb enough to buy the lower 300, and they don't realize that bad stocks stay bad for a lot longer than they ever imagined. 3M's not to buy here. So there we go. That's my prediction. It's an exciting time.
Thanks, Eladio. I appreciate that. It's the signal's starting to certainly agree with you in terms of certain components of the market, right? Like Tech XLK or certainly individual names. You mentioned Microsoft and Google, those and Netflix, those are all bullish trends. So at this point in time, again, I'd have to agree with you in terms of what you said generally in terms of kind of some of the larger, the 67 or the Elite 8. However, I guess they're Elite 8 now because of NVIDIA. But yeah, I mean, Tesla's and Amazon in the consumer discretionary side of the house remain bearish trend on our signal, Eladio. But they're the kind of the only two holdouts there amongst those Elite 8. So it'll be interesting to see kind of how things permeate further. The NASDAQ went bullish last Wednesday, I believe it was, on our signal. So again, it's taken, I know you mentioned it's been a bull market since December. I'd say, I think that's kind of considering where we came from in terms of November of 2021, kind of challenging to say that this rally is maybe less a bull market and more of a bear market rally, but at the same time, we are now back in bullish territory on the Nasdaq composite. That is not on the Nasdaq 100. Well, I mean, you would have to think I just wanted to clarify. Nasdaq composite is what the signal is on a daily basis. So, but yeah, no, I mean, it's interesting.
Yeah, and I agree. And if you don't mind me interjecting, excuse me.
No.
One other thing that you would have to add is we have been pricing the recession that never comes, and all 485 other components. Okay, let's stretch that to maybe about 40 stocks that have rallied, because you can't take out the AI phenomenon and but the rest of the market has priced in a recession that's never going to come, at least not this year. And there's where the value is, but there's not enough confidence. You can't. I mean, you could barely even see leaders like. I mean, I've always learned when you get an entry point, because if there's a pullback, you always move up in quality. Today, I started buying Chevron. I mean, there's nothing left above Chevron here. I'm sorry to say. Okay, because energy has been abysmal, and the market has turned into a option. On my birthday, I was on the shores of Rochester, right there in Lake Ontario. The waves were freezing. Yeah. I was having my Labatt's Blue out in the cold snow, and my son, was going to school at the time, and I just remember, I don't know why, but it made sense then to buy defense and to buy oil and energy. And if you weren't in by May, you're sideways on energy, my friend. Because every move here is manipulated, in my opinion. How hard it is to manipulate 20 stocks? If 20 stocks were responsible until 2 weeks ago, and BlackRock's so I mean, don't tell me it's not hard to prevent and prop up certain stocks from going down so that the indexes don't break. I mean, we're a top-heavy market, and so we're going to see a rotation, but it's going to be very messy. It's not going to be pretty. It's going to be with the fits from all AI people and the semiconductors, which are probably going to go down another chunk, it's you sometimes wonder, are we going against AI already and we don't even know it, because the moves that we see in the markets are outrageous sometimes, and if you're not in early, you got to be in early to be right. If you're in when the news is out, you're another CNBC bozo that watches the CNBC.
CNBC clown, the clown, right? The clown show.
Yeah.
Don't talk bad about AI because Alexa's listening.
Understood.
It's interesting you mentioned aerospace and defense, because that's something that I forgot to bring up, because it's been in the out bucket, right? So you've been able to see the bullish trend on the page in the out bucket for a few days. I'm going to say probably a week or so, I think, at this point. Maybe even longer than that, because I got it. 612. It doesn't matter. Don't need to waste time here. But it was added to ETF Pro today. So ITA Aerospace and Defense added back to ETF Pro. So it's a good call there in terms of the defense names. And I love that you're in Rochester, New York, on Lake Ontario. I spent many years on the other side of that, right across from you in Toronto. Also often on the lake right downtown.
Actually, I don't live in Rochester anymore. I live in the Mid-Atlantic. I have my that's my son. He was at Eastman School of Music.
Oh, cool. Okay.
Okay,
awesome.
he graduated,
yeah.
So I was there.
Nice.
I would go there, and we go skiing.
I love it.
It's a nice place.
Yeah, that's awesome. Yeah. Rochester, New York's beautiful. But cool, awesome. Well, I don't. I don't. Anything else, boys? What else did you say, Letty? You said defense, Chevron. So Chevron, that pays you a nice little divvy, eh? I kind of forgot about that. What did I forget? But
better Chevron than EQT.
Yeah. Well, again, as I mentioned earlier,
I started with EQT, worked my way up into ConocoPhillips and Fang and PXD, and then they started. And I guess the good ride would have been Exxon, but you can't catch everything. Tried to get into Meta after 3 quarters and thinking that was going to be it, and then they dropped the bomb then, and that was the time to buy. It went down to 88, missed that one. So that's not going to happen to me again with Tesla. Tesla, in my opinion, is going to hit 400 again before the summer. If you haven't figured out by now, that you don't bet against Elon Musk, then I'm sorry. He's the one with the yacht with the skis tied to all the yachts, as many as he wants, right?
Yeah. The high. So the
400. We're going to cross 400 here by the fall.
I think 407.36 was around the high.
I love Al Aaron. He's a class act. He's the best at telling us what has already happened, like no one. Man, I feel like I'm a college student at Cambridge, But come on, make a call. It's okay. We're going to be wrong. I've been wrong. In fact, I've learned more from being wrong than anything else.
Definitely.
In 25 years.
If you can't learn from your mistakes, you're certainly not doing it
all
right.
Well, it was nice talking to you. All right. Enjoy the rest of your evening.
Thank you. You too. All right, well, that's a fun way to wrap up. Why don't we just call it? It's an hour. So we got a lot of you saying that this bull market's running through at least the summer. So we got that going for us. Awesome. Well, appreciate it, Hedgeye Nation, for tuning in. Thank you all for your time. I look forward to engaging with you again this time next week, 4:30. It'll be the last week of June, last week of the quarter. So let's see what the market's got in store for us then. Between now and then, I hope you all have a very profitable endeavor out there. Cheers.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.